Hey everybody, this is Neil with Selling Puts for Income. I got an email from a reader named Robert about he wants um, weekly spread trades, which I haven't been focusing on as much recently. I've been looking at the monthlies and doing the condors. So I thought I would take this a minute or two to talk about weekly spread trades and how you can make them work, what you have to watch out for, and the inherent risks involved. So I'm here in one of my charting programs. This is a subscription service that I have. It does a nice little custom trend identifying thing, which I like. So this list here is all issues that have weekly options. I think there are more since I made this list, but these are the big guys. You got stuff like Amazon, Apple, Google, that kind of thing. So, um, whenever you're looking for a weekly trade, the the main issue that you have to deal with is the fact that because there's so little time value involved, you have to get much closer to the current market price in order to generate some premium. And we're going to be selling a near call or a near put and then buying a covering call or a covering put that's farther out. And that's how you create your spread. So as a result, as opposed to the monthly condors, this requires much more technical analysis. So what you want to do is go through your charts, look at your favorite stocks that have weeklies. Typically, I like the ones with that are pretty high priced. It gives me more strikes to choose from and different gradations of what percentage away from the current market price you are. So, for example, with Amazon at 362 right now, um, you know, a, a spread of $5 is a very small. It's a less than 1% move. Whereas if you have a $40 stock, a spread of $5 is 12%. So by using the high-priced stocks like the 300s for Amazon, the 500s for Apple right now, Google's up at 1,000. That gives you a lot more flexibility as far as choosing your strikes. So I'm going to look through, and what I'm looking for is a strong uptrend. And so Amazon here has a pretty good trend. Um, so that's looking good. Let's look at Apple. And not so great. You can see that this white line here is, or the thin white line anyway, is a it's a pretty long-term moving average. I think that's the 200-day, and it's been up recently, but you know it's had its trouble. So yeah, I want to stay away from that. Plus, it looks like it's rolling over a bit right now. Baidu, the Chinese search engine company, looking okay, not great. There's the Dow Jones, of course, the diamonds. And you can see we channeled here for a bit and then it broke out, so that could be a good play. Let's see, GLD. Nope, that's not what we want. Let's look at Google. Now Google popped on that earnings report, a month or so ago, and since then it hasn't done a whole lot. Goldman Sachs. Yeah, it's in a small uptrend, but it's been range bound. That actually could be a good thing. So here in Goldman Sachs, we see this thin white line is a long-term trend. It's been in a long-term upward motion. And if you want to zoom out on longer time frames, you can see exactly why. But we have a bottom here at 154 or so, or 152, and then it goes up, peaks, comes back down, makes a double bottom, peaks in the same general vicinity, bottoms again, triple bottom. So this bottom right here, we can see is very strong for this stock, at least in the past 6 months or so. So let's see. Right now, that low was 153. This low over here was 151, and this low over here was 151. So basically anything under 151 we can say is probably going to be pretty safe. and it's at 165 right now. I'm going to hop over to my brokerage and see what Goldman Sachs is doing as far as the options. So this is Options Express. If you use another brokerage, that's fine. And I'm going to do all range, look at put spreads, and the current weekly expiration is November week 4, which will end in just a couple days. So we wait for that to load. And okay, we want to pick our intervals. Well, let's just look at all the calls and puts first, just to see what we're dealing with. Okay, so there is a 150 option. It's only 3 cents though, so that is not very much. Let's go out one more week, see what happens. And 6 cents. Now 6 by 12 is the spread, and there's no bids anywhere under that. So although this is a pretty solid option, the market isn't there to trade. And this is the kind of thing you run into a lot with weekly options, because they're much less liquid, and the market makers just don't make as good a spread. But if I were selling naked puts, I would sell this 150 at between 6 and 12. I'd probably go for 8 or 9 cents, probably 8 cents, and I would do that all day long. Open interest is 830, so there's a fair amount of activity in that option, but not good for a spread trade. So let's keep looking. And let's go for IBM. And not a good uptrend. You might sell calls against this. But the thing about this kind of trading is you never want to fight the overall market. So right now the market's going up. We want to only trade in the upward direction, which means selling puts. So it's the rising tide lift all boats kind of thing. All right, let's look at Intuitive Surgical. I had a big decline here. So let's keep looking. The IWM, which is the ETF for the Russell 2000, one of my favorites. We've got this kind of trend line going here, and let's look at the IWM at 107. Now the nice thing about the IWM is that it's got options at every dollar, so you can very finely tune what you want. And what were we looking at? 107? Yeah, 107.10 is this trend line here. So let's look at what we have underneath. 31 cents. Okay. And then the 106, which would be a $1 spread, is 22 cents. Well, let's look at this week. We might even be able to get squeak something out for the last 2 days. Okay, 107 is 6 cents, and then the 10, from then on down it goes down to 3, 4, 2, whatever. Okay, so let's do 106.50 just to add a little extra safety. Now you can see here that there's a lot of volume here. There's a lot of open interest, even more than the 107 and the 107.50, which is kind of interesting. What likely happened is you can see these 8,000s, several of them. Probably some big firms were constructing some trades there. So one of the nice features about Options Express is that we can calculate what the trade would be before we enter into it. We can see what the probabilities of it and everything are. So by clicking this box and making it into an S, I'm telling the system that I'm going to be selling this option. And let's look at the 105.50. Let's just make it $1. So I'm going to buy the 105.50 and sell the 106.50, and let's see how that works out. Go trade calculator. And it autofills all that. And my credit is going to be, let's see, this is 4 by 4, so if we traded at the bid and the ask here, we would get nothing. Obviously that's not what we want to do. So let's say between 4 and 7 here, I sell the 106.50 at 5 cents, and then I buy the 105.50 at 3 cents. So that'll be selling 5, receiving 5, and paying 3, so that's going to give me a net credit of 2 cents. And we calculate, and I'll make, $2 per contract. Now, that's a 2% return on a $1 spread. The thing about weekly options is that your percentages on your returns are going to be much lower because there's so little time. But you repeat them over and over and over again. Really, what I like to look for on weekly trades is 1% per week. And, you do that 52 weeks in a row, that's 52%. And of course, sometimes it's better, sometimes it's worse, sometimes you'll have to take a little bit of a loss, sometimes you'll let it go to, expire worthless. So let's go to the probability chart. And this is our strike, 106.50. So we move this guy down here to line up. And the probability of expiring below 106.50 is 1.45%. That's very low, and that's what we want. Whenever you're selling a spread, you want to be in a very low probability situation. So we've got 1.5% probability, 2% gain. That's a win. So that is a solid trade. Now, because the yields on weekly options are lower, because again, you're dealing with narrower spreads, you're dealing with shorter amount of time values. You have to have be trading a significant number of contracts to make any money, because your commissions are going to eat you up. So, like on Options Express here, I think it's $15 for a trade as a minimum. And then once you get above that, it's like $1.50 per contract, something like that. So if I'm going to pay $15 per trade, I need to be trading I need to be trading 8 contracts just to break even on commissions, which is going to be, $800 of margin tied up, or of account value tied up. So I got to be willing to trade in significant volume in order to make this work. Now, if you have a small account, you can do that, or you can't do that. If you have a large account, you can. So it just kind of depends on your situation. And that's another reason I have started to move towards the monthlies, just because it's just easier to trade. I can trade one contract on the Russell 2000, RUT, and I can make a couple $100 per contract. So it's another factor to keep in mind. So let's say you have a good size account, you want to trade weekly spreads. This would be a good one. But let's keep looking. Netflix, that's always a fun one. Solid uptrend. I would trade this, we want to be beneath this band here. So I would be trading this below, I'd be selling below 315 or so, maybe 320 if you want to get aggressive. So let's look at Netflix. And okay, so at 320, we've got 19 cents. At 315, we've got 14 cents. And so if we did the 315 by 305, that would be $10 for a 3 cent, we could probably make it into a 5 cent spread. So that would work, but it's not a great return. The IWM is definitely better so far. So let's go to the OEX, which is the S&P 100, I believe, if I remember right. And okay, so we've got an uptrend going here. It's kind of taken off and broken out of its channel. So in my technical analysis, my combination of things that I'm looking at is that the Bollinger Band lower bound here is at 777, which also lines up pretty well with this top, and double top really. So a double top that's broken through is going to form a pretty strong floor. So I would trade this at 775 and lower, and this is the kind of stuff I mean by having to do your technical analysis on these weekly trades. So let's look at the OEX. Oops. Wrong button. Oh well, we'll figure it out. And we go down to 7... What did I say? I've forgotten already. Yeah, 775. So this option right here. Almost nothing. And the spreads here are pretty wide. So, again, we could do $10, 775 to 765. And if we tried really hard, maybe we could get, I don't know, let's say we sold this for 10 cents and we bought it for, well, 10 cents. There's just not a whole lot of spread there to work with. And when you get up here in the 780s, 790s, it's just too much risk for me. So we keep looking. So far IWM is the winner. Price line. Solid uptrend. Look at that. Poof. Okay. So again, I like to trade below the lower band of the channel that it's in. So right now, that's going to be about 10.45, which is way below 11.47. But let's take a look. $10.45. There's no 10.45. In fact, that's the market disagrees with my assessment. You can tell because that's where the bids end, so nobody wants to buy that option. Yeah, so if you want to be a momentum trader, this would be buying calls right here because you can't make money selling puts. So the bullish play is just to buy a call and ride its move upward, which very well may do. But that's a stylistic decision, I guess, on how you want to trade. RUT, same as IWM, so it's just different numbers. SPY is the the S&P 500's ETF, and yeah, I mean it's okay. Doesn't quite have the double top that we were looking at as forming a floor, as we saw in the OEX, but it's still looking good. I just know that the options aren't going to be there for it. And let's look at Visa. That'll be our last one. And okay, not a great chart. It's got a somewhat of an uptrend in the long-term moving average. I would probably trade this somewhere in between the 194 and the 190. So let's take a look at what we have for option choices. And the 190s, yeah, there's no bids, so there's not enough interest in this in these weeklies to make it work. So IWM is the winner. Well, let's just go back and okay, so we said 107. I think it was 106.50 was the one we were looking at. Actually, I think I still have the calculator up. Yeah, there it is. So yeah, if that's if you want to do the weekly trades, that would be the one I would do. Now, with that said, once you identify the trade, you always have to keep in mind what are your money management rules. When you could lose up to $98 for every $2 you win on this, and that is going to be typical of a weekly spread trade. Because you have so little time value that you're selling. So you have to decide, okay, how much am I willing to lose on paper before I cut the trade off? And for me, that's going to be less than 2% of my portfolio. And when you close a trade, just like on the condors, you would close it and then reopen it lower. So you'd roll the trade and try to mitigate those losses instead of trying to just do it in one shot and being done. But by staying this far away from the market, you do minimize your chances of that. There's only a 1.5% chance that this was ever gonna, be a problem. So there it is. IWM 106.50 by 105.50. It's a put spread trade, and it expires in 2 days. So that time value is going to erode rapidly. And that's it for now.